What drives gold prices? Whether gold will continue going up depends on various factors. Decisions of central banks on interest rates and inflation affect the price of the metal. Since lower interest rates and higher inflation both make it more expensive. The same goes for exchange rates, in the sense that a weak US dollar will cause gold to rise. Then, there is supply and demand of the metal itself. Gold mining is becoming more difficult over time, which is one reason for long-term increasing prices. All these will have a bearing on investors deciding to buy or sell gold. Futures are the exchange-traded funds, ETFs, that trade in the commodity indices, which include the precious metal. Also important is the level of uncertainty about the future of the economy, since gold is considered a safe haven in troubled times. Gold has enthralled humanity since ancient times. Still, it glitters from central bank vaults to jewelry bazaars the world over. The conversation brings you 5 essential briefings by academic experts on the world-favorite precious metal. For more articles written by experts, join the hundreds of thousands who subscribe to our newsletter. But as to how each factor exactly influences gold, the academic literature shows very mixed results for some of them. For instance, since the so-called commodity boom in 2005, there has been a heated debate about whether gold prices and commodities more broadly are driven more by economic fundamentals or by the behavior of speculators in ETFs. This turns on whether gold is essentially a financial product or a physical commodity. As with most things, the truth probably lies somewhere in between. I have been involved in this research. For instance, co-authoring findings that the margins that brokers charge on gold futures contracts can affect prices can be affected by the level of inventories of commodities, meaning how much is being held in storage, and the extent to which people are hedging against their prices going up or down. Should you buy gold? We found that investors who included gold in their portfolios alongside stocks, bonds, and cash were better off in the period from 1989 to 2009. This was true even after the risk of investment and the transaction costs are taken into account. Interestingly, this is not the case when investors start adding other commodities, such as cotton, copper, and live cattle. This highlights the distinct characteristics of gold and other commodities, to the extent that there is arguably no such thing as a commodity asset class, as I have emphasized, among other commodity investment pitfalls here. Instead, gold and crude oil seem to perform distinctly from the rest. Forecasting asset prices has never been easy, however, and investors always need to be cautious. To the extent that there is more uncertainty to come about the prospects for economic growth, including from COVID-19, and if low interest rates prevail, gold prices may well continue to rise. The more negative news on economic growth, the greater the increase in the price of gold. Even then, the direction of travel may not be straightforward. If bad news causes stock markets to fall again, investors may well sell off gold and other commodities to finance their losses in other assets. This will put a downward pressure on gold prices. Equally, the situation may well change if the current uncertainty is resolved. For example, if a viable medicine for COVID-19 is developed and/or the US dollar strengthens, gold could move in the opposite direction. The 2011 to 2018 decline in gold prices following a bullish period is a good example to keep in mind. If you like this article, find more expertise in our gold series. Countries went on a gold buying spree before coronavirus took hold. Here's why. Long before COVID-19, countries have been buying new reserves and bringing it home from overseas storage to an extent never seen in modern times. I'm a bit of a modern-day alchemist. Recovering gold from old mobile phones, there's 33 times more gold in the average handset and in the equivalent amount of ore. Yet the vast majority is never recovered. Meet the struggling gold miners who are missing out on the boom in precious metals. You would think that anyone in the gold industry would be getting rich right now. But informal miners in many countries are missing out. How the U.S. government seized all citizens' gold in 1930s. It seized all gold bullion and coins, forcing citizens to sell it well below market rates. Then, immediately after that confiscation, it set a new official rate for gold that was much higher. Subscribe to our newsletter. Get more news and information you can trust direct from the experts.